morning, Gauchos. I'm Liz Hollihan, Programs Director at Alumni Affairs. And on behalf of UC Santa Barbara alumni, I want to thank you all for joining us this evening for the February edition of Gaucho Academy presented by American Pacific Mortgage. The webinar series features keynote speakers and expert panelists who delve into topics pertinent to our Gaucho community. And I'm delighted to introduce Jason Matta, who will be leading tonight's home buying workshop. And without further ado, over to you, Jason.
All right. Thanks, Liz. I appreciate it. It's great seeing everyone this evening. I appreciate you taking time out of your busy week to join us for our installment of the home buying workshop series that we present. This is a class that I teach on a quarterly basis to the UC Santa Barbara alumni, and really glad that you get and spend some time with us this evening. Our class is a very interactive session, so as I get a chance to teach on our various topics, we encourage for you to ask questions from us. You can do that by just typing your question in the chat, or you can use the Q&A feature in Zoom, whatever you prefer. Myself and my colleague Ken will be kind of answering those questions as we go through, but we encourage those questions. That allows us to share other content with our audience. Just to help you learn a little bit more about American Pacific Mortgage, so we are a direct lender. Our team in particular specializes in homebuyer education for our local communities. And we do that through partnerships like our UC Santa Barbara Alumni Association partnership. So really proud to be a part of this partnership. This is our second year in working with them, and really proud to be able to chance to get this information out to you. I will be obviously your facilitator for this evening. I actually get a chance to work with clients one-on-one all throughout the country, designing home buying plans to help them on that path towards home ownership. So here's what you're going to learn a little bit about tonight. So we're talking about the housing market in just a bit. A lot to talk about there. I know we're on February 5th, but still there's a lot of stuff cooking in the housing market. We'll also spend some time looking at interest rates and how that can impact home buying. We'll also do some budgeting. So we're going to talk a little bit about, if I'm continuing to rent today, what could that look like if I decide to purchase a home in the future? And then from there, we're going to talk a little bit about credit, how to make sure that I'm in the best possible position from a credit perspective. I'll share with you some tips and tricks and resources around credit. We'll then transition to various loan programs that are available to you. And then we'll talk a little bit about saving. So as I'm preparing for home ownership, what should I be doing to save for home ownership? And then we'll kind of move that into first-time home buyer programs that really kind of coincide with savings. So different resources that are available to you as first-time buyers. I think most of us are joining us in California. So we partner with an agency called CalHFA, the California Housing Finance Agency, that's designed to help low to moderate income households and home ownership. And then we'll talk about the buying process. So after tonight's workshop, you may think, hey, how do I start this process? Where do I go from here? We're going to kind of share with you the buying process to go from attending tonight's class to getting pre-approved to finding the home of your dreams, and then hopefully moving into that home. And so we'll kind of wrap up our class tonight. We'll also talk a little bit about a consultation, which is an interactive session that I do on video with every client on a one-on-one basis to help design a home buying plan for them. All right, so that's kind of our plan for this evening. Really excited that you're going to join us for the ride this evening. We'll finish up tonight's class by about the top of the hour. And again, this is a very interactive session. By the way, tonight's class is being recorded, so tomorrow morning we'll have this class up on our YouTube channel. We'll also share back out with you, since we have your email addresses from registering for tonight's class, we'll also share back out with you tonight's presentation. All right, so let's think a little bit about home ownership and really the benefits that come along with owning a home. And, for some clients, this might not be the right time for buying, but I think it's important to think through the benefits that come along with home ownership. So when we think about buying a house as comparing to our current path of renting, this creates a little bit more stability in our housing budget. While home prices may be high, or, interest rates might be at higher levels than historically we've seen, there still is a lot of great stability that comes along with owning a home. Now, there is opportunities over time, even though we might be purchasing in a more elevated rate environment today. there still will be opportunities to refinance where in the future, which is where when interest rates start to go down at a lower level, we could potentially refinance to help us save money. When I think about some of our clients that are purchasing in today's market where, rates may be in the high sixes, well, historically, that's much higher than what we've seen in the past, right? Well, some clients will choose to refinance to lower that budget. And we'll see that from some of our clients buying today, but maybe looking to refinance over the next 2, 3 years or more. This is probably going to be one of the biggest financial investments you decide to make. And with that comes with the opportunity of a return on investment of that purchase. So your home, as it grows in value versus what you owe in the balance of that home, creates home equity, which for most of us is probably one of the largest assets that we have in our portfolio. And you do create an opportunity to create generational wealth potentially through real estate. And then finally, there's some really great tax benefits that come along with owning a home. So you may have not thought about maybe the tax benefits that can be woven into home ownership, but you could potentially deduct mortgage interest in home ownership and also other tax benefits that could come along with energy efficient upgrades to your home. So as we're starting tonight's class, one of the places I love to kind of launch into is to go into a rent versus buying calculator to talk a little bit about budgeting for home ownership. So I'm going to kind of move us into a rent versus buying calculator. And as I mentioned earlier, we're going to send out all this material to you, including the link to this rent versus buying calculator. But I think it's a good way to kind of frame up home ownership for tonight's discussion so we can get a sense of like, what's this going to look like if I continue to go down the path of renting versus what could it look like if I decide to purchase a home. So I've kind of pre-filled a few of the data points in here to keep us on track for tonight's class. But let's kind of take a look at this, and we'll first start with the rental section, which is kind of putting together if I'm renting today. So let's say I'm at $3,000 a month in rent. I have renter's insurance at $15 or more, depending on what you're paying today. And then we're going to assume that our rent's going to go up maybe 3% on an annual basis, okay? So that's in the kind of the rental column. And then from a buying perspective, let's assume we're going to buy maybe a $650,000 house. Depending on where you're at in California, maybe that's a condo or a townhouse or potentially a single family home. We have down payment. So when we purchase at a 650 level, the minimum down payment for a first time buyer using a conventional loan is 3%. We have property taxes for the home that we're going to factor into the equation. We have homeowners insurance, which will vary based upon where I'm going to purchase. And then we have maintenance costs that we want to build into the budget. Okay. Now, so that kind of frames up the home ownership side of it, but we also want to factor in what does the financing look like that I'm going to take out if I decide to buy a home. So generally for most first-time buyers, we're going to elect a 30-year fixed mortgage, which that means the payment is fixed for the next 30 years. Today's rates on average are somewhere around the high 6 range, so we'll put 6.875 for our discussion. You have origination costs. And so when we think about origination charges, those are costs that a lender is going to charge for obtaining financing through them. Now, one of our things with a UCSB alumni partnership is that we actually discount our services by $750 for your origination costs. So that's another added benefit you have beyond our classes that we teach quarterly to help ultimately create better affordability for you when you do decide to purchase a home. And then this next section is discount points. And what are discount points? Well, that gives the consumer an ability to be able to pay additional funds out of pocket. We call those closing costs to help lower their interest rate. Usually one discount point is the equivalent of 1% of my loan amount. Now, in today's market, I don't really recommend clients paying discount points. And the reason why I say that is because the return on investment for costs like that is usually about 3 to 4 years. And so for many of our clients, like I mentioned earlier, that are purchasing in 2025, they're probably going to consider refinancing in the next year, maybe 2 years down the road. So we don't really reap a good return on investment for something like discount points. And then we also have other settlement services. Those are going to be things like title and escrow charges. Those could be like county charges. Those will vary based upon what you negotiate with the seller. In total, when we think about closing costs, I always encourage buyers to budget for anywhere between 2 to 3% of their purchase price for closing costs. And then the last tab here is other assumptions. So we're going to look at our home projections and say, okay, we think our home could potentially appreciate about 4% on an annualized basis over those next 7 years. We factor in selling costs of our home. We also bake in state and federal tax rates, and then finally the savings rate. So when we look at the side-by-side comparison, I think the first thing we have to look at is what do our payment differences look like, right? So, on the rental side, I have $3,000 a month. If I want to purchase, now my budget's gonna step up pretty dramatically at a 650 purchase price, especially with a minimum down payment of 3%. So that moves my payment or elevates my payment to $5,500 a month. So a $2,500 increase. But where we have to look a little bit beyond things is when we compare our opportunity over the next 7 years of owning my home versus renting, it creates about an $81,000 opportunity for me. And how I get there is from the appreciation of my home over the next 7 years, as well as the potential tax deductibility benefits that come along with home ownership. So when we're building our home buying plan for ourselves, I would say we don't want to consider this like an apples to apples comparison, because at the end of the day, homeownership is going to provide so much more and from a benefits perspective. Now, it's not maybe the right timing for everyone. So that's why it's important for you to kind of really understand the tools and resources that are available to you in homeownership. And so when that time does come, we're going to hopefully successfully build a good budget for you to be able to pursue that goal. Well, transitioning from budget, let's talk a little bit about the housing market, because that's on top of mind for most of us. Like, we understand cost of living is high, especially in our markets in most parts of California are going to be, super expensive, right? And so if we look at median home price in California is like 800,000. Most markets are going through the seasonality right now, which generally is, when we're in colder months here in most parts of the country, we start to see a little bit of a slowdown in home purchases, inventory. We still have an inventory challenge in most parts of the market, so there's not enough supply to support the buyer demand. But from a demand perspective, we're seeing a lot of buyers coming out earlier in the market. Generally, we see an uptick in buyer activity in April, May, and June, so your warmer months across most parts of California. But right now, just to start 2025, at least, we've seen a massive uptick in buyer activity. I think a lot of that centers around where interest rates are at, because I think everybody's been kind of waiting, buyers, sellers, for interest rates to come down. We just haven't seen that. I mean, we're still at elevated levels. I don't think that's really going to change much over the course of 2025. So when we looked at the housing market, average home on the market staying about 45 days, you're seeing home prices slip a little bit here, but I do think some of that's driven out of the seasonality in the markets. I think the challenge that we face in most markets that we serve across the country, like I said, is just supply. And I think eventually, as interest rates come down, buyer demand will increase even more so. And then we could see, more uptick in prices. That kind of remains to be seen. But I do think we're going to probably be at elevated levels in interest rates, at least throughout 2025. And hopefully, as we move into 2026, we'll start to see interest rates come down a bit. I think it's important to kind of put this in perspective, though. I mean, if we look at interest rates over the last 20 years, we've had plenty of highs and lows in interest rates over the last 20 years. I think for those of us that are exploring home ownership most recently in the last 2 to 3 years, most of us may think that, interest rates are coming back to 2.5% or 3% levels at some point, which really isn't the case. If you look at the last 20 years, and let's kind of just do a flashback to the early 2000s, interest rates weren't terribly far from where we're at today. In fact, you kind of look at our chart here off to the left, you see the blue line represents the 30-year fixed mortgage, which almost coincides to where we're at in February 5th of 2025. So interest rates look very similar. Of course, home prices look a lot different. But we see some kind of similarities there. Now, this kind of shows you where interest rates have gone over the last 20 years. This kind of represents a recession here, the housing crisis. And then this line represents the pandemic. The reality is a return to 2.5% rates hopefully will never happen, because obviously then that would represent some major crisis like we went through with the pandemic. But ultimately, historical levels are usually around 5.5% in interest rate. So we're certainly above that in today's market. But as I've mentioned a few times now in tonight's discussion, most of our buyers entering today's market will probably consider refinancing at some point, which ultimately means that as rates drift lower and I'm an existing homeowner, I could potentially take advantage of refinancing my existing mortgage balance into a lower rate. Well, before we move on from interest rates, let's look at the last 12 months that we've kind of been on this little bit of a roller coaster ride, which this chart represents. Interest rates dipped down to a nice little low here in September. We were all excited. We started getting to the low sixes. We thought more was to come, but then things have quickly changed. And, we elevated to over 7% to end 2024, post-election into 2025, kind of around that 7% level. Now, today we've had a nice little movement in interest rates going about 0.125 lower. That may not feel like a big movement for most consumers, but in our world, to see interest rates move 0.125 or even a 0.25% is pretty significant for us. And certainly, the lower interest rates go, we create better affordability. Now, all interest rates are not the same for all buyers. So I think it's important to understand that credit score and ultimately eligibility plays a factor in what your interest rate might look like. So even though your colleague or your neighbor or a family member achieved a 6.25% rate, doesn't necessarily mean that you're going to get a 6.25 rate. Market conditions, type of product will play a role in that. The type of down payment I have, which basically translate to how much I'm in financing, my down payment, like I mentioned earlier. And then we talked earlier about discount points. That will play a role in what my interest rate looks like. So if today's rates are at 6.875, but I really want to achieve a 6.5% rate, well, that might cost me funds out of pocket in the form of discount points. And so those will play a role in what my outcome of interest rate looks like. Again, not something we'd recommend in investing in discount points, but it is an option as a buyer. And generally in markets, when you condense the term or shorten the term of your loan, you will generally see lower interest rates. This market is not as such because short-term and long-term rates are very similar. So in a normal market, you would see a 30-year fixed mortgage going to a 15-year fix, creating about a 0.5% difference in interest rate. But unfortunately, we don't see that in today's market. So, but at the end of the day, most of our first-time buyers are going to elect probably a 30-year fixed mortgage product. As I get a chance to meet with clients and design home buying plans for them, we're going to figure out what product selection and ultimately the outcome of that interest rate looks like. We manage and monitor interest rate activity daily, beginning at 6 a.m. all the way through the end of the trading days, because interest rates move every minute, believe it or not. And so it's, there might be little minute movements in the market, but ultimately it affects the outcome of what a buyer's product might look like. A big factor that makes up product selection and interest rate selection will be credit scores. And so in our classes that we teach throughout the country, we like to talk a little bit about credit, give some kind of visibility as to how credit scores are made up and give you some resources and tips and tricks, I guess, if you will, to think about from a credit perspective. Every product that's offered by lenders has a minimum credit score, and you can see those on screen. So the FHA loan, which is a federally insured loan, minimum score of 580, conventional loan 620, our VA home loan product is 620. And then we'll talk a little bit about first-time buyer programs tonight in California. The CalHFA product has a minimum credit score of 640. Now, there's other factors to consider in credit scoring. Major events like bankruptcies or foreclosures or short sales can have a bigger impact on credit scores. Events that have transpired in the most recent 12 to 24 months are going to have the biggest impact to your score. But as I move further away from that event, so if I had something happen to me 3 years, like a late payment on a student loan, that will be less impactful than, say, a late payment that I had in October of 2024. Credit utilization, we're going to talk a little bit more in the next slide, but ultimately when we think about credit utilization, we're looking at revolving accounts. So we're looking at the limits I have on my revolving accounts versus my active balance. So if I have, $10,000 in limits, my balance is $5,000, I'm ultimately at 50% utilization of credit. We're going to give you some ideas to think about and how to manage down utilization. Account closure, we're referring to closing out a revolving account. You want to be cautious in doing that because when you close out a revolving account, it strips away all your history that you've had built up with that creditor and ultimately could lower your credit score with the credit agencies. Now, we all know there's three agencies for credit reporting. There's TransUnion, Equifax, and Experian, right? So they all have three different risk score models. And so that's why you'll have different scores coming up with different agencies. There are also different models within those agencies. So there's the credit card model, there's auto financing, and then there's the mortgage model. So many of you that are monitoring your credit through, let's say, Credit Karma or any other resource that you're choosing, most of those scores will reference a credit card score. So oftentimes clients will reach out to me and say, hey, Jason, you said I'm a 740 credit score, but Credit Karma said I'm 765, right? It's just the difference in the modeling between the two products. Now, in lending, we always look at the middle credit score of all three bureaus. And so what I mean by that is if my highest score is 760, let's say my middle score is 740, and then my last score, my lowest score is 720. Well, when we evaluate product options, interest rate selection, mortgage insurance, we're going to take the 740 credit score for qualifying purposes. Now, if I'm going to apply with my partner, but let's say my partner scores are just slightly lower, they're at 720, 700, and 680. Well, my partner score is the lowest middle score between the two of us at 700. So I would have to kind of reconfigure the financing based upon the 700 score, which could impact the product, but more importantly, probably impacts the interest rate option as well as possibly mortgage insurance for that particular client. So as we get a chance to meet with our clients to design our home buying plan, like we're going to figure out how we kind of structure the financing to provide really the lowest financing option or most inexpensive financing option for our clients. Now, I just want to kind of share with you this grid that kind of shares with you negative items. So if you've had bigger events on your credit report that are maybe kind of dragging down your score, this is how long they'll appear on the report. But again, to my point earlier, the event taking place in the most recent 12 to 24 months will be kind of the bigger impact to the score. So as I get further away from that event, my score should start to kind of organically go up. Let's take a look at the weighting of the score calculation, because I think it's important to really understand that whether have had credit for the last 10 years or you're just building your credit, I think it's important to understand how the weighting is situated with a credit score model. So let's talk first about the length of credit. So that occupies 15% of the weighting. So the more mature my credit file is, potentially the higher my score is going to be. If I've just started credit in the last 6 months, well, that's probably going to be, most impactful to my score because I just haven't had the maturity in my credit file. The next weighting is how much new credit am I trying to get access to? Am I opening new accounts? Do I have new hard inquiries on my credit? That occupies 20% of the weighting. Now, just as a quick little side note, when you decide to start the process with us and design your own home buying plan, we only do a soft credit score. And the reason why we do that is because we don't know how long the buying cycle is going to take for our clients, right? It could be 2 weeks, it could be 2 years. And so a soft score allows us to evaluate options and build a plan for our clients without impacting the credit score. And I think that's a big part of, making sure our clients are taken care of. So, but ultimately in use of credit is 20%. Then 30% goes back to that utilization we talked a little bit about earlier, which is ultimately probably one of the biggest areas of opportunity for most clients. Let me give you a quick tip on how to manage utilization. Maybe it's kind of a homework assignment, if you will. Tonight, if you have some time, take a look at one of your most recent credit card statements. You're going to see 2 dates on that credit card statement. One is your due date, which we all know, but the more important date is the billing cycle or statement date. That date is which the credit card issuer closes out all the activity for the preceding 30 days and then reports that out to the credit agencies. So the tip for you tonight is that if you could pay down your balance before your end of your statement or cycle date, you're going to get a much lower balance, of course, but also lower credit utilization, which helps to elevate your credit score. So just a little way of kind of managing your credit card a little bit differently. And then finally, payment history is also going to be a big impact item for your credit score. It occupies 35% of the weighting. If you do have late payments, they're rated generally as 30-day lates, 60-day lates, and then 90-day delinquencies. All right. I'm just gonna make sure I didn't miss anything there. Okay, so let's talk a little bit about student loans, right? And with student loans, we all know they're in, well, if you have federal student loans, they probably are in forbearance right now. I believe there's gonna make a ruling on some of these federal student loan debts in September or October. I think it's important to have some visibility as to how lenders look at student loans right now, especially when you have loans in forbearance or deferment. So deferment generally comes when I'm maybe back in school or just newly graduated and I haven't activated my accounts yet. If you have an active income-based repayment program plan, we can use that payment immediately for qualifying. However, if you're in forbearance right now and you're trying to now activate an IBR plan, that might be a little bit more challenging because, from what I understand, the federal student loan servicers are not accepting IBR payments until later on this year. So, where it becomes a little bit challenging is on the lending side. If there's no IBR payment in place, we have to take the existing payment that you have, or on an FHA loan, we take 0.5% of the total balances and we use that as our payment, or on a conventional loan, 1% of the aggregate balances. So that's just something to kind of share with you, because obviously in working with alumni associations all across the country, clients will at times have student loan debt. So we want to make sure we kind of navigate through that properly. You may not be paying a certain amount right now, but we have to budget an allocated amount based upon what the guidelines show. But ultimately, if you are on an income-based repayment program today, that's great. We can use that payment right away, as you can see on our example here. So if we have somebody that's paying $75,000 in student loan debt, or sorry, has a $250 payment on $75,000 in student loan debt, we can use that for qualifying right away. Okay, we're going to talk a little bit about program guidelines, but I want to take a quick pause because I know I've given a lot of content so far. I just want to make sure I take some time out for any questions. Again, as I mentioned earlier, you can use the Q&A function in Zoom or the chat feature. If you do have some questions, I can answer those on air. We'll also carve out some time at the latter part of tonight's session to answer any questions. But any questions from our group so far? Okay. All right. Let's talk a little bit about the guidelines for some of our programs. And we kind of like to spotlight 5 of the main programs that we generally offer. But I think a lot of our conversation tonight will center around the 2 programs off to the left. So let me just give you kind of a high level look at each one of these programs. The first product is a conventional loan. You may have heard conventional terminology, which ultimately centers around Fannie Mae and Freddie Mac loans. It's a 3% minimum down payment for a conventional loan. Sorry, I got my little graphic coming up there. It's 3% down payment for a conventional loan for a first-time buyer. Minimum credit score of 620. Now, you can see a maximum loan amount, which is 802,650. That's the conforming loan limit set by Fannie Mae and Freddie Mac every year. That those usually get published around October, November, and then they institute those limits for the next year, so for 2025. Now, some of us, or most of us, I should say, are in California. Guess what? We all know California is a high cost of living state. And because of that, Fannie Mae and Freddie Mac have adjusted loan amounts that go to higher levels. So if you're joining us from LA County, for example, that loan limit goes up to $1.2 million, essentially. If you're in Santa Clara County, guess what? High cost of living goes up to $1.2 million. So there is some adjustments based upon certain markets that we serve. Now, once we go beyond a loan amount of 802,650, that minimum down payment no longer is 3%. It elevates to 5% because it is considered what we call a high balance loan. And we're going to do a comparison just a bit around mortgage insurance or private mortgage insurance, comparing conventional loans versus the FHA products. I did get a couple questions popped in the chat, so I'm going to answer those before we talk about FHA. First one is, I have a student loan that I owe more than originally borrowed, but I paid off 2 other loans in full. One loan is 20 years old, but the other is from 10 years ago. Will that have a negative effect if I am on an IBR payment? So the time frame at which you've had a student loan doesn't impact eligibility. We just ultimately are looking at the balances, but more so the payment. So if you're on an IBR payment, that's totally fine. And then another question was about first-time home buyer programs. As first-time buyers, don't you have a 0 down payment? We're going to talk about first-time buyer programs in just a little bit. There are first-time buyer programs. that will help substitute in resources for the down payment, but it's not necessarily a zero down payment. It's just where you get the resources for down payment. All right, let's talk about FHA loans, and they are first-time buyer assistance programs for FHA. FHA has a minimum down payment of 3.5%, minimum credit score of 580. The maximum loan amount on FHA is usually 763, 600, but that can change based upon the county that you're going to purchase in. So that could look a little bit different depending on where you're going to purchase in the country, but each county has a maximum loan amount. FHA is a government insured loan. You're going to learn a little bit more about how mortgage insurance works on these type of loans. But ultimately, the FHA loan has a little bit more flexibility in terms of guidelines. You can see that on screen with the difference in credit score requirement. And we're going to kind of go into some other features of FHA in just a bit. The VA home loan product provides veterans with lending sources. And the VA loan does have a zero down payment option. There really is no maximum loan amount on an VA loan. There's a minimum credit score of 620. The VA product has a lot more flexibility for the veteran to get access to home ownership. When we think about expenses versus income, a little more flexibility there. As you can see in the minimum credit score requirement, a lot lower than your standard products. Some veterans may have eligibility for an exemption to what we call as a funding fee. So for the VA home loan product for first-time users, usually there's a VA funding fee, which is usually around 2.3% of the total loan amount. If our client has any partial disability from the VA, that funding fee is waived as an exemption. The USDA product, you may have heard about that. That does stand for the United States Department of Agriculture, is backed by the USDA. That is a zero down payment option. However, there's two requirements on the USDA product. I have to purchase in more of a rural area. So there's some geographical restrictions. And then there's requirements or limits, I should say, based upon the household income. Great tool to help our buyers get access to home ownership, especially in those rural markets. The jumbo loan would be the next product. Those are for clients that need a little bit more funding resources than what we can provide through, say, a conventional loan that maybe exceeds the $1.2 million loan amount or maybe even the conforming loan limit. However, there's a little bit of a trade-off because the down payment requirement is slightly higher on a jumbo loan, usually elevated credit score requirements. Not necessarily something that a first-time buyer would need as access to, but certainly is an option for first-time buyers just with that more elevated down payment. Now, for buyers, a question comes up a lot around mortgage insurance and, what does it do? How much does it cost? And so we like to kind of explain what mortgage insurance looks like. PMI stands for private mortgage insurance. And ultimately what that means is you have private companies that are insuring mortgage companies against a potential maybe default by a consumer on their mortgage. Maybe there's a financial hardship or whatever the case may happen. That mortgage company is protected by PMI. PMI is connected with a conventional loan, and there's government mortgage insurance on an FHA loan. So let me explain a little bit to you on both topics. A conventional mortgage insurance premium is built based upon what your down payment looks like, what my credit score is, and then ultimately, how much am I deciding to finance? Okay, so that may vary depending on if I have a higher credit score, elevated down payment, that will help bring down my mortgage insurance. It's not like a one size fits all situation. On conventional mortgage insurance, there is a cancellation option. So generally when I reach 2 years and achieve 20 to 22% equity, I can apply to have that mortgage insurance canceled. Now, for those of you in class that maybe have started your home search on Redfin or Zillow already, that's great. I mean, super easy, right? If you've decided to use some of their calculators there, that's where mortgage insurance might be a little misleading because mortgage insurance, honestly, on a conventional is not super expensive, especially for those that have maybe elevated credit scores or putting more money down. So we want to provide you with an example here on screen, which you can see like a conventional loan for someone that's going to buy a $700,000 house and chooses to put 3% down and maybe has a 740 credit score. That mortgage insurance is $209 a month. Some of those calculators will lead you to believe that it's $300, $400, maybe even $500 a month. So it's a little bit more affordable than you might think. And then of course, if my credit score goes to 800 or maybe I'm putting 10% down, that mortgage insurance lessens. Now, FHA mortgage insurance looks a little bit different. So there's actually two forms of mortgage insurance. There's monthly mortgage insurance, which is the equivalent of 0.55% of my loan amount. And then what we do is we divide that by 12. to give us a dollar figure. And then there's upfront mortgage insurance, which is 1.75% of my loan amount. That gets added into your total amount financed. Now, with mortgage insurance on FHA, whether I have a 780 credit score or a 580 credit score, like the mortgage and premium does not change. And with the mortgage insurance on FHA, I can't cancel it like I can with conventional loans. In fact, the only way to exit the mortgage insurance with an FHA loan is ultimately to refinance into more of a conventional product. As I look at the FHA product, it's not going to be the long-term solution for most of our clients. This hopefully will bridge the gap for a client to get access to homeownership, and then hopefully at some point look to maybe refinance into a conventional loan product. If we look at the FHA mortgage insurance calculation, it looks like this. So if we take that same $700,000 per loan amount, we have the upfront mortgage insurance, which is $12,250 that gets added into the amount financed, the 1.75. Then we have the monthly mortgage insurance premium, which is $320 a month. So that gets baked into our calculation as well. So, you look at the side-by-side comparison, clearly FHA is a little bit more expensive, right? But I think it's important to understand that as we build home buying plans for our clients, we're just going to figure out what the right path is for us, because not all clients qualify in conventional products, but FHA can be a solution that can help our clients get access to home ownership where otherwise they might not have been able to attain that. All right. Let's talk a little bit about qualifying income. And I want to kind of just dispel some myths around like eligibility around income, but also kind of share with you now some documentation that's needed. So as you decide to take those next steps and get connected with us to build your own home buying plan, here's some of the documents generally a lender would ask for. So last 2 years of W-2s, usually last 60 days of pay stubs, possibly 2 years of tax returns, especially for self-employed, and then last 60 days of asset statements. So that's usually what we ask for in gathering documentation. I want to talk to you a little bit about kind of the myths around like qualifying income. So in lending, we have a 2-year requirement to verify that our client has either 2 years in employment history and or education. And so, some clients are led to believe that they have to have 2 years on the job, which is just kind of it is a myth. You can actually build a home buying plan for yourself. Let's say, for example, I just graduated from UCSB in the fall, but now I just started my job January 1. As long as I have 4 years of educational support for the basically that supports my field that I'm working in now, that would qualify for 2-year requirement. So in fact, I don't even have to be on my job 2 years. So even if I was transitioning to a different job, maybe not had the educational background, but I had maybe 1.5 years with one employer, another year with my current employer, that would make up my 2-year history. So I don't have to necessarily be on the job 2 years per se. Now, where it gets a little bit more challenging is if maybe I have a dual employment. So sometimes we see this in the medical field where I'll have a client that works at 2 different facilities for an employer. Maybe I have 20 hours a week at one job, 30 hours at another. In that case, I do have to show that I've been on both jobs simultaneously for the last 2 years. And if I'm self-employed, I do have to show that I've filed 2 years consecutively of tax returns for eligibility. So that's where those things get a little bit different. Any income considered in the application has to be documented on the application, meaning that if I'm going to apply in just my name, but let's say I have my partner's income, but my partner's choosing not to be a part of the application, then that income generally can't be included. Same thing holds true with like rental income. Let's say I'm renting out a house right now and I gather rent income for a room that I have rented out. That income can't generally carry with you to the next property unless you're generally buying, let's say, like an investment property or whatnot. All right. And so the last thing I want to kind of touch on here is also we have situations where clients are working a 40-hour work week job, but maybe on the weekends they drive for Uber or Lyft, and that happens often where they want to use that income for qualifying. Well, that is considered 1099 income. That income will generally show up on a Schedule C for a tax return. In order to count that income, we just have to make sure that that client's been working that 40-hour work week and working for Lyft or Uber simultaneously for the last 2 years. As we think about income from the lending standpoint, we also compare that versus expenses. So we have a calculation called debt to income ratio, which is really pretty simple. It looks at your expenses that you have versus your pre-tax income. So when we think about expenses, we're looking at things like student loans, personal loans, credit cards, car loans, maybe overdraft or lines of credit that we have with our bank. Those are all things that get factored into the expenses. We also want to consider, what is our new housing expense going to look like? For example, as you can see on screen, we have our PITI, which is one of our acronyms in lending that stands for principal and interest, property taxes, and homeowners insurance. And then let's say we're putting less than 20% down. We have private mortgage insurance, or PMI, that we learned about earlier, and then maybe an HOA expense if maybe I'm buying a place that's in a condo community or maybe a townhouse. Now, we're going to assess those expenses versus the income. Generally speaking, we don't want the expenses to exceed more than 45% of the income. Now, at times we can go as high as 50%, which is completely allowed in the guidelines. But as a rule of thumb, we don't really want that to exceed 45%. The question I get from clients is, well, where should I be in terms of debt to income ratio? And as I work with clients all across the country, usually affordability pushes our clients to about 33 to 36% debt to income ratio. So meaning 33% of my income is consumed by my outgoing expenses. Affordability is a super important conversation that we're going to have during our home buying plan discussion. So we really want to figure out that if I'm going to transition from $2,500 in rent to $4,000 mortgage, like, is that something that's affordable for me? But it also, is it sustainable for me over time? Because debt to income ratio is simply just an analysis for us that we can kind of figure out qualifying, doesn't indicate necessarily affordability. All right, so when we look at home buying for our clients, there's can be two challenges at times. It can be around credit, because maybe our utilization or a little bit overextended, or maybe some new student loans have just come online that we're having to make payments on. More so, though, it's centered around savings for our home buying. So in this section here, I just want to talk to you a little bit about what's needed in terms of documenting what you already have saved, but how do we build a plan towards home ownership and saving? So let's talk a little bit about what sources are acceptable for down payment. Well, checking and savings accounts over the last 60 days that we can source assets, that completely works. We can't use any cash deposits. So anything that's out of the norm of your usual banking activity, we got to kind of talk through that a little bit. 401k loans can be potentially used. We always encourage you to talk to your tax advisor or your financial advisor before you get access to those type of accounts, including brokerage accounts. And sometimes family members will contribute towards your home purchase. We call those gift funds, completely allowed in financing. There really is no limitation on gift funds. Those can also be used in conjunction with various assistance programs. So that all of that stuff is allowed in home financing. So let's talk a little bit about savings, and let's kind of drop a little bit of an example. So, if I'm currently spending $2,000 a month in rent, and after meeting for your home buying plan session, you say, hey, you know what? I think I can afford $3,500 a month for a new home, right? But maybe the gap right now is just saving for down payment as well as closing costs. Well, assistance programs can help provide resources for that. But if we're trying to build savings, here's what I would encourage you to do. If we're okay with that $3,500 a month expense, but I just lack the savings, what I would encourage you to do is start saving like you're paying that $3,500 mortgage on day one today. And what that does, it does a few things. One is, over the next 6 months, I'm going to start being able to gather more or grow more in my savings, not including interest. After 6 months, by simply transferring $1,500 on a monthly basis and letting that money sit, in 6 months, I have $9,000 accrued. In 12 months, I have $18,000 accrued. And that is a huge step in savings for our clients. So it provides that as kind of the nest egg for homeownership, but it also creates a second thing, which is the discipline of that monthly payment. Because ultimately, when we decide to take that leap into homeownership, it's going to be a transition, right? It's going to be a little bit of a little payment shock for us. And if we can start building that momentum of paying like we're making that $3,500 mortgage payment now, but saving, it's going to create a rhythm for you that when you become a homeowner, it's just a lot easier, right? So that's our savings plan that we would kind of encourage you to think about. Now, in California, there are assistance programs available to you as well. So we get a chance to partner with CalHFA, which is the California Housing Finance Agency. We've been the number one lender for CalHFA over the last 6 years, I believe. And this is a resource that's available to those that are purchasing in the state of California. Last year we rolled out the second wave of the Dream for All program. You may or may not have heard about that. We're currently funding out those that actually achieved vouchers for that program through the lottery system. So I get a lot of questions of, is that program going to come back online or not? We don't know at this point. There is no plans at this point to bring Dream for All back online, but certainly we'll let our communities know that as we hear that stuff. Today, CalHFA offers a few different programs. One is the MyHome Assistance Program that on a conventional loan allows you to borrow up to 3% of your sales price, which creates a separate loan for you at a 1% interest rate, which is really cool. They don't have you pay that back until you either sell the home or if you refinance in the future. And then on an FHA loan, you can get up to 3.5% of your purchase price, which is that separate loan to cover the minimum down payment for your FHA loan. So 3% for the conventional loan, 3.5% for the FHA product. So one of our questions we had earlier is there zero down payment options? Well, there's not zero down payment unless you use a USDA or a VA product, but you can do a conventional and FHA product and get resources to supplement the minimum down payment. Now, there's always local community programs. The budgets may vary for some of those local, like LA community products, or maybe the city of Santa Barbara has a product. Those will vary, but this is a state-funded program. Funds are always available through the state. So that's the down payment and closing cost assistance resource. There's also a separate closing cost assistance program called ZIP, or zero interest program. It's a 0% interest program that you can get resources to help with your out-of-pocket expenses. ZIP is a little bit challenging right now because it really elevates the cost of the first mortgage rate, whereas the My Home Assistance actually offers usually a lower than market rate. So that's kind of a subject to change. We do have another kind of a private label product within APM called the Pathway DPA product. It's only functional with an FHA product, but ultimately provides 3.5% to 5% in assistance. It will help support our clients that maybe have lower credit scores that are trying to obtain home ownership. And there's also the Golden State Finance Authority program. That's another California-based product. And then Fannie Mae offers some low-income housing assistance programs. So there's lots of great resources that are available to you. If you're not in the California market and maybe you're in Nevada or Texas joining tonight's class, we can certainly talk about other state products offline, but generally most states have a HFA or housing finance agency. And ultimately, it's designed to support low to moderate income first-time home ownership. Let me give you a quick example of how the CalHFA product facilitates the assistance. So if I was to buy, let's say, a $700,000 house and I had a 3% down payment with closing costs, which we average at like 2 to 3% of your purchase price, without using any type of assistance program, I would probably need to save $35,000 to $42,000. And that might not be challenging for most of us, but for many of our clients, it is. So when we think about the My Home Assistance Program, that allows us to insert 3% of the sales price in assistance to augment that down payment. So maybe a client is not putting $35,000 to $42,000, maybe it's $14,000 to $21,000 out of pocket, which is a huge difference. And of course, the ZIP assistance is available as well for our clients. So those are ways that we can help create new opportunities for homeownership, where for some clients, it may feel like a big long-term goal to achieve homeownership, and we try to make it more of a near-term goal. Last thing I want to leave you with on the CalHFA product before we talk a little bit about buying process is eligibility requirements. So a first-time buyer is someone that hasn't owned in the last 3 years. So if I owned a home back in 2019 and I'm trying to re-engage and buy again, you're still considered a first-time home buyer as long as you haven't owned in the last 3 years. Minimum credit score usually for the product is 640. And then the income qualifications for the product are usually 150% of the median income, which is quite lenient for most first-time buyer programs. Now, this is only eligible for one-unit properties like condos, single families, townhouses. I get questions a lot about manufactured homes. Manufactured homes, it has to be on land that you own. It can't be like in a park or anything like that. And sometimes in communities, we'll see what we call as below market properties or BMR properties. This does comply with BMR communities as well too. Here's what those income limits look like. We kind of just spotlighted most of our Southern California counties. I think we just don't have San Diego up here, but these are all available. We can get you the full list. In fact, we might be able to put them in the chat there for you. These income limits are updated every June by CalHFA. So just in a few, 3-4 months, we're going to see some new income limits out. But this on the income limit side, we just look at applicant income. So most first-time buyer programs look at the whole household income, but with CalHFA, we're just looking at applicant income. So here's what I mean by that. If I'm trying to purchase in LA County where the limits are 194, and let's say I make 150 and my spouse makes $100,000, if I'm looking to apply just in my name, then only my $150,000 in income is considered for qualifying. All right. I know we got a few minutes left in our class, and before we wrap up, I do want to talk a little bit about the buying process. And so after tonight's class, you may say, hey, where do I go from here, Jason? I love the content, great resources here, but how do I start my path towards home ownership? Well, the first thing I'd encourage you to do is get connected with us for a free consultation. That's a 30-minute session with me to help design a home buying plan for you. And I'll show you with you more in just a minute what a home buying discussion looks like. But the output of that meeting would be essentially to have you pre-approved, which is our first step in our 6 steps of home buying process. What a pre-approval means is you now have a baseline of eligibility. So if you're deciding to purchase, in the next month, the next year, the next 3 years, at least you understand kind of the basic framework of home buying for you. The pre-approval is usually good for 60 days, but we can always recertify your pre-approval at any time. So you're not forced to run out and buy a house right now. We want to make sure that you get everything kind of aligned for yourself financially, but we're going to help you kind of understand what your options look like. So that's step 1. Then that will take you to step 2, which ultimately is the house hunting. So some of you in tonight's class may have already even started your house hunting. Maybe you've been kind of looking around on Zillow or Redfin or Trulia, whatever platform you're looking at. But ultimately, that online search will go to in person, right? You'll start viewing homes. We would encourage you to connect with a local realtor that should be an expert in their market, understand what options are available. They should be an expert in negotiations and have really good resources to provide you school reports, walkability in a community, whatever it is that's most important to you. We'd encourage you to get connected with a realtor. Now, as you look at different options of homes, we can update your pre-approval at any time. In fact, after tonight's discussion, I'll be updating a pre-approval for a buyer in the San Diego market because that's what we do as we it's a very fluid process as you're doing the home shopping. Now, let's say you kind of spotlight the home you love, you make an offer, the offer gets accepted. That's going to move us to step 3, and that's called entering escrow. So now you have an agreement with the seller to purchase that home. That same day, you'll get a call from our team saying, hey, congratulations. You did it. You have an accepted offer. Let's now talk through a little bit about what you're going to expect and what next steps look like. Well, one of our next steps is to meet with you again for a follow-up consultation just to make sure the design of your financing looks right. What are current interest rates today? How much are going to be expected to put out of pocket? What's my monthly payment going to look like? We want to make sure we create the basic starting point for you. So as we move through the process, you understand exactly what you're going to achieve here. Now, there are some action items as a buyer. You're going to have to make a deposit on your home, which is usually 1% to 2% of your purchase price. Those funds will count towards your out of pocket. It also triggers us to initiate disclosures for your loan, which are e-signature disclosures. We also order an appraisal of your house to ensure the house is worth what you're purchasing it for. So all those things start to begin at step 3. This is what an earnest money deposit looks like. I kind of highlighted that earlier. So usually 1% to 2% of your purchase price. And most contracts in California and abroad have contingency periods, which allow the buyer to do their homework on the property, which would include getting the house appraised to ensure the house is worth what you're buying it for, getting the house inspected. A realtor will usually organize that, get a home inspection, maybe a pest inspection, sewer inspection, roof, whatever you feel like you need to do to investigate the property properly. And then finally, we'll get your loan approved. And of course, as a lender, we would handle that for you. So that kind of happens during that contingency period. Now, your deposit is protected while you're in that contingency period because now the administrative tasks start on the financing, like the processing and the underwriting of your loan. The rate of your loan is subject to change until you lock in your interest rate. Now, rates don't generally get locked in until you have an accepted offer with the seller. But in today's market, there is some strategy around locking in the lowest available rate. We start monitoring the interest rate market daily at 6 a.m. until the end of the trading day. So we consider ourselves kind of expert on kind of managing through the market because market rates will change every minute. And so it's important to understand economically what's going on so we can try to seize that opportunity for you. Step 5 is the loan approval. That's where an underwriter has issued an approval. They've reviewed your income, your assets, your credit, making sure the right product is selected for you. That should happen within the first couple weeks of the transaction. As a team, we'll be working with the underwriter to fulfill any conditions of the approval. And as we're moving through the process, you're getting e-signature disclosures sent to you. And at step 5, we've now sent to you 2 previous disclosures, and we issue a final closing disclosure at step 5, which ultimately creates a 3-day cooling off period before you go to the final stage called closing your loan. And that's kind of really the finish line. At the closing of the loan, that's the one time we have to meet in person. So you'll be meeting with a public notary or escrow officer to sign in-person documents. You'll then wire your final funds on that day. Those monies get all reconciled by the escrow team. And then us as a lender will audit your file just to make sure we haven't missed anything and then send the funds to the escrow team. That escrow team then records documents with the county recorder's office. They record a grant deed, which is ultimately the transfer of ownership to you from the seller, and record a deed for your loan. And so after all of that gets reconciled and recorded, then guess what? You become the homeowner. And that's really kind of our that's the finish line, right? That's the chance where we get a chance to celebrate with you. And it's a huge accomplishment. This is going to be one of the biggest financial decisions you decide to make. And we're just privileged to be a partner to join you along that journey. But it doesn't stop after you get your keys to your house. So we have various aftercare things that we do for you, including our rate watch program, because some clients are going to purchase today at elevated rates, and in a couple of years they may want to refinance. Well, part of our rate watch system, we're going to notify you when the time is right to refinance. We also enroll all of our clients in a HomeBot system, which will track kind of market value of their home as well as opportunities for refinancing, and then do annual check-ins with our clients to make sure that you're in the best possible position. Because guess what? Things change financially over time for our clients. Our family grows, we want a bigger house, maybe we want to do some home improvements, maybe we want to change our debt and we will restructure things. So things are always evolving for our clients financially. We want to be there when those changes come about. Well, as we're wrapping up tonight's class, we're almost to the top of the hour. You may be thinking about, hey, I want to kind of learn a little bit more about what this looks like for me. If you do have some questions after tonight's class, we'd encourage you get connected with me for an introductory phone call. You may have some questions that you want to ask on a one-on-one basis. We can do that through our scheduling system by selecting the introductory call. If you're ready to get started with the process and do a consultation, again, it's a free service we provide to our community. There's a 3-step process to get started there, which includes doing an online application. We only do a soft credit check. You'll then upload proof of income and assets, and then use our scheduling system to either schedule a video or a phone session. I always encourage video because we like to screen share the different options with you to kind of make sure we have the design work done. The consultation looks a little bit like this. We're going to talk about budgeting. Where do I want to buy? What do I feel like I have saved? Do we need to build a savings plan together? What assistance programs might work for us? And then, like I said, the output would be to create that pre-approval for you. And it doesn't have to be a situation when you're running out and buying a house this weekend, right? This can be a plan that we're building for the next year or 2 years. We just want to be a partner with you along that journey. Now, we do have other resources available to you via mobile. We have our APM mobile app, which you can actually do your application right there. You can use the calculator function, which we find really handy, that if you're out looking at homes and you want to run some payment scenarios, you can do that via mobile. But it also pushes notifications to you and gives you real-time status updates on what's going on with your home financing. Again, this is going to be the biggest investments you decide to make. So we do try to make it a very high touch experience for you. So we leverage technology through mobile, email, of course, phone, and then just the human element of things too. So we want to make sure that we're here with you along the way. We're obviously incredibly proud of our UCSB partnership with the Alumni Association. We offer beyond our workshop discounts like our $750 closing cost discount that you'll be eligible for, whether you're buying a house or refinancing one day. And of course, our workshop platform is always available to you in our local communities that we serve. And we also have other partnerships available across the country. So if you have a friend, family, maybe a colleague that's thinking about home ownership, we'd encourage you to check us out and some of the classes we're doing. We're going to host over 50 classes this year. So we're going to be busy with just educating our local community. So if you feel like this is something you found useful and you want to share that with others, feel free to pass along some of our content information. You can find our full list of classes at mortgageeducate.com. And again, as I mentioned earlier, we recorded tonight's class, so that'll be up on our YouTube channel. You can see our social channels here on this last slide. And this is all my contact information. So if you do have questions after tonight's class or just want to get connected with me, don't hesitate to reach out, shoot me a text or email, call, or again, you can always schedule some time with me as well too. So we're right at the top of the hour. I see some stuff popping in the chat, so I'm going to answer those as well as any questions you have. So we'll stay as long as we need to answer any questions from you. I think most of you are holding on the line, so I do appreciate that. So let me answer one of these questions, which is if you want to purchase in a different county than the one you live in, is the maximum income on the destination county. So I think we're referring to the CalHFA product. So yes, it's based upon the county that you're going to buy in. So if I live in LA County right now, but I'm going to move up to Santa Barbara or Ventura County, then it will be based upon the Ventura County limits. That's specific to the CalHFA assistance program. Thank you for that. Just make sure. Any other questions from the group? I know I'm probably the next thing in front of dinner for everyone, so I appreciate everyone holding in there. Okay, awesome. Thank you for that. Okay. I think we did it, unless I'm missing something. Again, we'll have this class up on YouTube tomorrow morning. We'll get you all the presentation content. And I do appreciate you taking time out of your busy schedules. I know, it's not easy to carve out an hour, but hopefully you found this useful and a good resource for you on this journey. And I do hope I get the opportunity to be able to connect with each of you to help you on that pursuit of home ownership. I wish you all the best. Have a wonderful evening and look forward to connecting with all of you soon. Good night.